What if I told you there is a company out there that just grew its revenue by 129%, boosted its vehicle deliveries by over 60% year over year, and is sitting on margins that most EV makers would kill for rye, and the stock is still getting absolutely obliterated? Welcome back to Smart Stock Sam, the channel where we cut through the noise, follow the money, and find the trades that actually matter. If you found this video searching for whether NIO is a buy right now, a deep technical breakdown, or what the July numbers could do to this stock, you are in exactly the right place. We are going to cover all of that today, and I promise you, by the time we are done, you are going to look at this ticker completely differently. Buckle up, because this one is going to be wild. Now, before we get into the numbers, I want to paint you a picture of what we are dealing with here. NIO is currently trading at $4.86 a share, $4.86, for a company that just posted a 129% jump in quarterly revenue, for a company pushing out nearly 38,000 vehicles in a single month, for a company that just hit 18.8% vehicle gross margins in the middle of one of the most brutal electric vehicle price wars the world has ever seen. If that does not make your head spin a little, you have not been paying attention. This is one of the most glaring disconnects between operational performance and stock price that I have seen in years, and Wall Street has a very specific reason for creating it. We are going to expose exactly what that is today. So here is the full picture, right up front. On one side of the scale, you have the operational story: 129% Q1 revenue growth, 62.3% year-over-year delivery growth, and that beautiful 18.8% vehicle gross margin. On the other side, you have a stock that has plummeted 30% from its May 2026 peak. 30%. That is not a healthy pullback. That is a stock trapped in a brutal downtrend, artificially weighed down by geopolitical pressure, technical resistance, and some very deliberate options hedging by market makers. The business is genuinely thriving. The stock is suffocating under forces that have absolutely nothing to do with how many cars NIO is actually selling. And that, right there, is where the opportunity is hiding. Let me walk you through exactly how strong the delivery trajectory really is, because raw percentage numbers can sometimes feel abstract. In May of 2026 alone, NIO pushed out 37,705 vehicles. That is that 62.3% year-over-year jump in a single month. And it brings their year-to-date total to 150,526 deliveries. When you plot this out on a chart, you do not see noise. You see a clean, aggressive stepladder growth pattern running from late 2025 straight through the spring of 2026. We are living in a macroeconomic environment where consumers are supposedly pulling back hard on big discretionary purchases, and NIO is somehow finding a way to accelerate its volume. How? Because of what they are actually selling, and this is where the story gets really interesting. The secret behind that 18.8% gross margin is NIO's premium product mix. These are not cheap commuter vehicles. These are high-end, high-margin electric vehicles built for buyers who actually have money to spend. Their new flagship SUV, the ES9, just hit 10,000 deliveries in its first 30 days on the market. That is a genuinely record-breaking launch for a premium battery electric vehicle in that segment. Their third-generation ES8, meanwhile, has now crossed 120,000 total deliveries, cementing its position as the top-selling large SUV in its class. And here is the catalyst I want you to write down right now. Pre-orders for a brand-new 5-seat variant of the ES8 are set to open on June 28, 2026. That is tomorrow for many of you watching this. A new variant launch from a high-performing product line is exactly the kind of event that can shift near-term sentiment fast. This structural margin expansion is what fundamentally separates NIO from the cash-burning EV startups that are losing money on every single sale they make. Now, beyond the cars themselves, let us talk about the moat, because I think this is the piece that most retail investors are sleeping on. NIO just launched their 9,000th global battery swap and charging station. 9,000. No other company in the global electric vehicle industry even comes close to matching that kind of infrastructure footprint. Battery swap technology is NIO's ultimate ace in the hole. It completely neutralizes range anxiety for their customers in a way that traditional fast charging simply cannot match. And on the production side, their F2 factory just received the prestigious Global Lighthouse designation from the World Economic Forum. That award recognizes only the most advanced AI-driven manufacturing operations on the planet. NIO is building cars faster, smarter, and more efficiently than most legacy automakers. When the World Economic Forum hands you that recognition, you are not playing in the minor leagues anymore. You are competing with the best manufacturers on Earth and winning. So again, incredible business execution. So then why is the stock a horror show? Why is a company hitting all of these milestones trading below $5? Let us get into the part nobody on financial Twitter wants to address clearly, because this is where most retail investors completely lose the plot. The geopolitical risk premium. This is the dark cloud hanging over this ticker. The United States Department of Defense recently placed NIO on its list of so-called Chinese military companies. Now, NIO has forcefully and publicly refuted this designation and is actively fighting the label. But the damage on Wall Street happens the moment the headline drops. It injects massive regulatory uncertainty and instantly freezes U.S. institutional appetite. Large fund managers in the States simply cannot hold assets with that kind of government target on their back without serious compliance risk. The capital just stops flowing. But here is what NIO is doing about it, and this is the strategic move that I think is genuinely brilliant. They are actively working to upgrade their Hong Kong listing from secondary to primary status. Why does this matter so much? Because a primary Hong Kong listing gives NIO access to the Stock Connect program. And Stock Connect is the bridge between Hong Kong markets and the massive pools of mainland Chinese institutional capital. By pivoting to primary HK status, NIO essentially sidesteps the frozen U.S. liquidity problem entirely and taps into a completely different and enormously large pool of buying power. This is not a desperation move. This is a long-term structural pivot that redraws the map of who owns this stock. But until that mainland money starts flowing in, the price action on the chart is telling a painful story. The stock has fallen in a clean descending channel over the past several weeks, bleeding out 30% from the May peak. And we have now arrived at a critical make-or-break moment on the weekly chart. The price has retreated directly onto a major macro support line, a long-term ascending trend line that has acted as a key floor multiple times in NIO's trading history. This is the line in the sand. If this level holds, it becomes the launch pad. If it breaks, the floor falls out fast. And right now, the technical indicators are not giving us the green light just yet. The technical diagnostic across multiple time frames is currently reading strong sell. The current price of $4.86 is trapped well below its 20-day simple moving average of $5.39 and even further below its 50-day average of $5.86. Those moving averages are not support right now. They are ceilings, actively pushing the price down. An April golden cross, which many traders got excited about, completely failed to hold its momentum and has since collapsed. When we look at momentum indicators, the 14-day RSI is sitting at a neutral 46.54, not oversold enough to trigger a bounce signal, and the MACD is printing negative at minus 0.056. Everything about this technical picture says the momentum is stalled, which means we need a catalyst to unlock it. Let me now map out the exact battlefield levels for you. From our current position at $4.86, immediate support sits just below us at $4.70, aligning with a key Murray math line. Below that, you have secondary structural support at $4.26. But here is the warning, and I need you to hear this clearly. If that long-term weekly trend line cracks, the ultimate downside exposure, what I am calling the floor, is all the way down at $3 even. That is a long way to fall. On the upside, any meaningful rally attempt is going to slam into heavy structural resistance clustered between $5.87 and $6 even. That is a very tight and highly contested channel. Any breakout above that zone would be genuinely significant. Now here is where this story gets really weird, and honestly, kind of exciting, because despite how ugly this chart looks, the smart money is quietly making a very different bet. Overall, institutional ownership sits at 280,200,000 shares across 459 institutional owners. And yes, in the most recent quarter, there was an overall 12.18% decrease in total institutional positions. That is the scared money running from the geopolitical headlines. But look at who is actually buying into this weakness. BlackRock, the largest asset manager on Earth, increased its NIO position by 92.17%. Renaissance Technologies, arguably the most successful quantitative hedge fund in history, increased its holdings by over 70% to 14,450,000 shares. Major algorithmic funds like Quadrature Capital and Two Sigma are also heavily increasing their stakes. These are not amateur investors making emotional decisions based on scary headlines. These are the most data-driven, rigorously analytical institutions on the planet, and they are buying the fear hard while retail runs. That is a signal that deserves serious weight. So if the smart money is accumulating, who is suppressing the price? The answer lives beneath the surface of the visible market. Above the surface, there are 134,170,000 shares currently sold short, with a days-to-cover ratio of 5.08. That means if every single short seller decided to exit their position simultaneously, it would take 5 full trading days just to buy back those shares at normal volume. That is an enormous amount of trapped short pressure. Below the surface, between 34 and 52% of all daily trading volume is being routed to dark pools, off-exchange platforms where large institutions can move huge blocks of shares without pushing the visible ticker price up or down. That elevated dark pool volume is actively obscuring true price discovery. The market you are seeing on your screen right now is not giving you the full picture. And none of that fully explains why this stock seems almost magnetically glued just below $5. For that, we need to talk about the options market, specifically the $5 magnetic pin. At the $5 strike price, there are 10,299 call contracts and 9,315 put contracts sitting in open interest. Above that, at the $5.50 strike, there is an even bigger wall of nearly 21,000 call contracts. Here is why this matters mechanically. Market makers who sold all those options have to hedge their exposure by buying and selling shares constantly. As the price approaches $5, their hedging activity creates a powerful gravitational pull, drawing the stock toward that $5 level so that the maximum number of options expire completely worthless. The overall put-to-call ratio is actually bullish at 0.33, which tells you there is more call interest than put interest. But implied volatility is suppressed near 55 as traders have loaded up on downside protection ahead of upcoming data releases. The casino, as always, is working hard to keep its money. Now let us talk about what Wall Street analysts actually think this is worth when they look past all of this short-term noise. HSBC has a buy rating with a price target of $6.80, citing strong 2026 volume growth and clear visibility on margin improvements. Nomura upgraded the stock to buy with a $6.60 target, recognizing that NIO is transitioning into a demonstrably healthier business cycle. Bank of America, maintaining a neutral rating due to the intensity of domestic EV price competition in China, still holds a $6.70 price target based on NIO's strong product pipeline. All three of these targets represent upside of 35% to 40% from current levels. These are not moonshot predictions. These are conservative, institutional-grade assessments of fundamental value. So what breaks this deadlock? 3 catalysts, and all roads lead to the July 1st data drop. Catalyst number 1 is June deliveries. To hit their second quarter guidance, NIO needs to deliver between 42,939 and 47,939 vehicles in June. That requires a 14 to 27% sequential jump from May's number. If they hit the high end of that range, the short squeeze math gets very dangerous for the bears. If they miss badly, the trendline support faces a real test. Catalyst number 2 is the Hong Kong listing upgrade. The moment that Stock Connect inclusion becomes official, we should see an immediate and potentially sharp influx of mainland Chinese institutional capital. Catalyst number 3 is Onvo brand traction. NIO's new mass-market sub-brand needs to prove it can compete in China's cutthroat budget EV segment. Tracking sales metrics for the Onvo L60 and L80 is going to be absolutely crucial for the full picture. Here is the actionable setup for the week of June 29th through July 3rd. The directional bias is long. Your entry zone is between $4.75 and $4.86, using that $4.70 Murray math line as the launchpad. Your strict stop loss is at $4.65. If macro support breaks, do not hope. Exit the trade. Your first profit target is between $5.10 and $5.18, clearing the heavy options pin at $5. Your second target is $5.39, testing the 20-day simple moving average. The squeeze rationale is this. If June delivery numbers hit that 47,939 vehicle ceiling, those 134 million short shares face immediate and intense buying pressure. Market makers who hedge those put options will be forced to unwind their delta hedges, triggering mechanical buying above $5. The fundamentals are primed, the smart money is positioned, the trap is set. We wait for the data. Now, before I wrap this up, I need to be very direct with you. Everything discussed in this video is strictly for educational and informational purposes only. Nothing here constitutes financial advice, and I am not a licensed financial advisor. All investing and trading carries significant risk, including the total loss of capital. The analysis you just watched is based on publicly available data and represents my personal opinion only. Always do your own research, understand your own risk tolerance, and consult a licensed professional before making any investment decisions. Past performance and analyst targets are never a guarantee of future results. Never invest money you cannot afford to lose. So let me recap it for you. NIO is not a broken company. It is a fundamentally strong business operating under the weight of geopolitical headlines, a structurally suppressed stock price, and one of the most explosive potential short squeeze setups I have analyzed in this market cycle. The smart money is already positioned. The catalysts are days away. And retail investors who understand what is actually happening beneath the surface have a genuine edge going into July 1st. Whether this trade works perfectly or not depends entirely on the June delivery number. And that data-driven uncertainty is exactly what makes this setup so analytically compelling rather than speculative noise. Now I want to hear from you. Drop your answer in the comments below. If NIO hits that 47,939 vehicle target for June, do you think the short squeeze actually triggers above $5? Or does the geopolitical overhang kill the momentum before it can run? Tell me your thesis. I read every single comment. If this breakdown gave you a new angle on this trade, smash that like button. It genuinely helps this channel more than most people realize. And if you want analysis like this every single week before the crowd catches on, make sure you are subscribed with the notification bell turned on so you never miss a drop. Want to go even deeper? I have just launched the Smart Stock SAM membership community, and it is already delivering serious value to members who joined. Members get early access to trade setups before they go public, priority replies when you send in your questions, and custom analysis built specifically around your portfolio or watch list on request. If you want to level up your investing and trading with a real community behind you, the membership link is right below this video. Click it, check out the perks, and join us before the next big setup drops. And if you want to support this channel directly, YouTube's Super Thanks feature lets you do exactly that. Every bit of support keeps this research coming. See you in the next one.